So the put call parity equation helps in terms of knowing the value of one option when the other option value is been available, right? When you say when put option price is available, so easily you can know what can be the call option, or like vice versa. Like if the call option price is available, you can know the put option price. So this is the importance of a put call parity, right? So one option price is available, easily you can know what is the price of the other option. That is one advantage. Second is it also helps in terms of arbitrage, right? So in the future we have seen how is that you can try to create the profit by using arbitrage opportunity. In options also we can try to look for arbitrage opportunity, right, by using a put call parity equation. So here we try to use a put call parity to know the value of the one company over the other company, the price of one asset over the other asset, right? So in the sub question B, what is that it is asking you is use a put call parity to price a European put option with the same strike price, right? So as we have already calculated the call option in the first question, sub question A, we have already calculated the call option price. So we have to use this call option price, right, to try to know what can be the put option by not using the binomial Black-Scholes model, right? By we have to use a put call parity equation, right? So by if you just look at here the sub question B, use a put call parity to price a European put option with the same strike price. So the equation, what is the formula for the put call parity, right? So the equation for the put call parity is C, that is call price C, that stands for plus K. K stands for your exercise price as a strike price into e to the power of minus RT, that is exponential to the power of minus R is a risk-free rate into time to expiry T is equals to put price P plus S naught. Okay, that is C plus K into e to the power of minus RT equals to P plus S naught. So you have a one bunch. You can call it as a one portfolio. You can call it as a left hand portfolio and you can call it as a right hand portfolio, right? So on your left hand portfolio, what is that it includes is a call option, only the call premium and the strike price of the call, right? And the one condition here is the both the call and the put, the strike price would be the same, right? On your right hand side portfolio, you have two things. One, you have a put option, and other you have a spot price, right? So there are the two what you say the assets are involved in your right hand side portfolio, that is put option plus S naught. Okay, so put option is a derivative, S naught is a spot investment. Whereas in your left hand side, you have only call option, right? So what the put call parity says is the equation of your left hand side portfolio and the right hand side portfolio, the value should be equal, right? If the value of the both the portfolio is equal, then there is no arbitrage opportunity, right? And the value is different, then there is a arbitrage opportunity, right? So now here we are not trying to look for arbitrage opportunity. So what is that we are trying to do here is only we are trying to know the value of a put option, how to calculate the value of a put option. Now we take the standard formula, that is C plus K into e to the power of minus RT equals to P plus S naught. So C, that is the strike price, C is what we have calculated in the previous answer. We calculated that, we got the answer as a 13 in the sub question A, right? We'll substitute the same value there. If not, we had to, it would be given there, right? So 13 plus strike price is 150 into e to the power of minus R, that is 0. What is the risk-free rate here? Risk-free rate is how much is the percentage? 10%?
6%.
How much? 6%. Okay, 0.06 multiplied by time to expiry is how much is the time to expiry? 3 months. 3 divided by 12. Okay, 3 divided by 12. Fine. So that is your left hand side plus right hand side P. P is where you are supposed to calculate P plus 155. So 155 is the spot price which has been prevailing in the market, right? When you simplify this, right? So 150 into e to the power of minus 0.06 into 3 divided by 12 plus 13, simplify and equals to P plus 155, right? So you take P equals to, right, the left hand side value minus the 155, so you will be getting as 5.77, right? So this is what by using a put call parity equation. Fine. right? This is in simple about calculating the put call parity to know the price of one asset when other asset price has been missing. Okay. Now let's move on to the actual put call parity and understand about like arbitrage process, right? So in this process, I have been forward you some 4 questions on put call parity equation using the using the option valuation, right? So you can refer to the questions which has been submitted in your group. Now I will take out each of the problem here, right? First problem, just go through the first problem here. Go through the first problem and try to understand what exactly it is. Okay. So before I just said put call parity, I'll just give you once again the brief idea about the put call parity and how exactly the arbitrage can be carried here, right? So put call parity equation is C for call price plus K is exercise price multiplied by e to the power of minus RT equals to P plus S naught. Okay. So this is one left hand side, what we call as a left hand side portfolio and the right hand side portfolio. You have 2 portfolios here, right? So left hand side portfolio is only the call option, put a right hand side portfolio is both put option as well as like a stock price, right? So when we compare the both the thing, when both are same, there is no arbitrage opportunity. When there is a difference, right? When there is a difference between the left hand side portfolio and the right hand side portfolio, when there is a difference, then there exists a arbitrage opportunity, right? When there is a difference, then next question is which is higher value and which is lower value, right? So that is the next important thing that you need to understand here, right? So comparing left hand side portfolio with respect to the right hand side portfolio here, right? When you compare the 2 things, right, the higher value of the portfolio, right? If you compare left hand side, that is call option one side and the put and the spot price other value, the 2 values when you compare the value of the portfolio, either the left hand or the right hand, right? If it is higher value, one would be the higher, one would be the lower, right? When it is equal, both are same. If there is not equal, either one value would be, one portfolio would be the higher value, the other portfolio would be the lower value, right? Let's assume here, right, my left hand side portfolio is overvalued, right? But it means the value is higher, right? If it is higher, then it is overvalued. When it is overvalued, then I need to look at what exactly that involves in this portfolio, right? So the things that involved in the left hand side portfolio is what is it it includes in the left hand side portfolio? What assets are included in the left hand side portfolio?
Call price and strike price.
Yeah, call price and the call strike price. It means only one position, right? So you are supposed to take only one position. That is when the portfolio value is higher, it indicates that it is a short position. It is overvalued and you need to take a short position, right? So you are supposed to take short on a call on the left hand side portfolio. Now on my right hand side, it is less value compared to the right hand side value is less compared to the right hand. So it means it is undervalued. When it is undervalued, you have to take a long position, right? Suppose you want to take a long on a put option, whether you will be receiving the premium or you're supposed to pay the premium. When you take long on a put option, whether you are going to receive the put premium or going to pay the premium.
Pay the premium.
Right, you need to pay the premium, right? So second is when you other position is S0. S0 is what? Spot price. When you say undervalued, you need to buy. Agree? You need to buy the stock. You need to buy the stock and you need to take long on a put option by paying the strike price, right? So both involves cash outflow. When you take short on a call, it involves cash inflow. When you take long on a put and you take long on equity, it involves cash outflow. But you also know that an arbitrager is a person who will not be investing his own money, right? So he will be trying to borrow the money from the bank or from the available sources and invest the money, right? In this cases, what happens, you need to know how much is the total money that to be borrowed, right, for paying the put option and for buying the asset. That is in the case if the left hand side portfolio is higher value compared to the right hand side portfolio. Now you say me, if the right hand side portfolio is higher value compared to the left hand side portfolio, then what should be the action plan here? What would be the action plan? Let's say right hand side portfolio is overvalued. If the left hand side portfolio is overvalued, then what position that you need to take? What
Short
positions that?
position, sir.
Short position on short position on put, right?
Short on put.
Yeah, short position on put you need to take. So you will be receiving the premium or you will be paying the premium if you take short position on a put.
Receiving, sir.
Yeah, good. You will be receiving the premium. Then you need to take a short on equity, right? If you take short on equity, will you receive the cash flow or you need to pay and buy the asset there? Short on equity. Short on equity. If you take short sale on equity, short sale on equity, short sale on equity. What exactly happens in the short sale on equity? Yes.
Sell the equity, sir.
Yeah, you will sell the equity share, you will receive the cash, or you need to pay the cash.
Receive, sir.
Yeah, in the both the case you will receive the cash, right? When you take short sale on equity, you will receive the cash. When you take short position on the put option, you will receive the cash. So what you will do here, you have to invest this cash, right? So you will be depositing this cash at the risk-free rate, right? At the other side, when you take long on equity, right, you need to pay the cash because you want to take a long on equity, you have to buy the long position for which you need to pay. So how much is the premium that required to pay? What you will do? How much is the cash that you have been receiving? Right, from short position on put option and short sale on equity, from there you deduct your premium to be paid for the call option and the rest of the money that you will be investing into the bank, right? So this is how the arbitrage process will be taken up. Okay, now let's try to understand the situation here, how to move ahead with the arbitrage opportunity. Okay, now here is a problem to you all. Suppose a 3-month European call and a put option strike price is trading for 30. One of the condition here for what you say when you go for put call parity is make sure that the strike price of call and the put should be the similar, right? So both the call option and the put option strike price is 30, with the premium of call option is 3 and the premium of put option is 2.25. As I said earlier that put call parity is useful for two things. One, either it will help, One, it will help to know the price of the asset, right? If you know the call, if the put option is unknown, you can calculate the put option, or if you know the put option, you can calculate the call option, right? That is a one advantage. Second, it is also for arbitrage profit. But if you look at here, both the call and the put price has been given to you, right? So you are not trying to know the price of the premium here, but you are looking for the arbitrage opportunity, right? So call and the put premiums are being given. So call premium is 3 and the put premium is 2.25, and the spot price of the underlying stock is rupees 31, right? And the spot price of underlying stock is rupees 31. What is the spot price? That is yes not. Okay, and the risk-free rate prevailing in the market is 10% per annum risk-free RF value. Discuss arbitrage profit if exists, right? So it is asking you if there is an arbitrage opportunity, you can discuss it. As you know, you cannot decide right now whether the arbitrage opportunity exists or no. You have to substitute the values into the equation. So if both the values are same, the left hand portfolio and the right hand side portfolio, then there is no arbitrage opportunity. If there is a difference between the left hand side portfolio and the right hand side portfolio, then there is an arbitrage opportunity. Fine. These are the given details. So K stands for the strike price, which is 30 for both the call and the put. S naught is the spot price that is being given as 31, and the risk free rate is being given as 10%, and the time to expiry of the contract is 3 months. Call premium is 3 and the put premium is 2.25. Fine. So put call parity. So nowhere it has been discussed that you are supposed to use a put call parity. Sometime they may mention you use put call parity, or they may not mention you to use put call parity. What they say is just apply the arbitrage process, right? When you say arbitrage process, you need to understand that you are supposed to use a put call parity equation here, right? So put call parity model is a standard formula you have here. That is C stands for capital C, the call premium plus K, the exercise price into e to the power of minus RT equals to put premium P, capital P plus S naught. Now we will substitute the values. When I substitute the value, the call premium C is 3 plus strike price is 30. Strike price is 30 into e to the power of minus R. Risk-free rate is 0.10 into 3 divided by 12. Right. So time to expiry of the contract is 3 divided by 12 is equals to put premium. Put premium is 2.25 plus the spot price is 31. Right. So simplify first. 3 divided by 12 multiplied by 0.10, then take exponential to the power of minus value, then multiply that with 30, then add up 3. That will give you the value of your left hand side portfolio, that would be equal to 32.26. Right, the value comes out to be 32.26 value, and the right hand side portfolio value, that is very simple to substitute, that is 2.25 plus 31, it comes out to be 33.25. Right. So by looking at it, it is very clear that my left hand side portfolio, which is less value 32.26, is less than 33.25. So hence the left hand side portfolio is undervalued. When it is undervalued, what position to be taken here? What positions to be taken when it is undervalued?
Long position, sir.
Yeah, you need to take long on a call, right? So you're supposed to take long on a call there. When my right hand side portfolio, which is value 33.25, which is greater than my left hand side portfolio, so I call that as overvalued, right? When it is overvalued, I need to take a short position. I need to take a short position on a put option. I need to take a short position on a short sale on the equity. Fine, clear? Now let's look at how exactly the things go on. That is today, because you know that the contract is going to get expired after 3 months. That is at the end of the 3 months. So you are supposed to take the action plan today. So what would be your action plan? My action plan would be first, either you can start anything. You can start from your left hand side or you can start from your right hand side. It is always better to stand from the sell because you will receive the cash, then long position where you're supposed to make the payment. So I'll start with my right hand side position where I had to supposed to take short position on a put option and short sale on equity, right? So I will take short position on a put option for at the rate of strike price of 30. If I take short position of put option where I have an obligation to buy, right? So when I take short position on a put option, so I'll be having obligation to buy at rupees 30 from a put buyer, right? So I'll be receiving a premium of 2.25 rupees, right? So then I will take short sale on equity. When I take short sale of equity, as simple, what happens here is, so you will be selling the share today in the market for rupees 31. In future date, you expect that the price of the stock will be less than 31 and you can buy at less price, less than 31, and pay back the share to a broker, and you can make the money, the difference in the lesser price at which you are buying and giving back the share to the broker and the price which you have been sold today, right? So difference would be the gain. If the price falls less than 31, you will be making a profit on the short sale on equity. If the price goes up beyond 31, so you'll be making a loss on your short sale on equity. Fine. In the same case, when is that you will be making a loss? When you take short position on a put option. What change in the price we will be making a loss when in the case of like short position on put option, whether increase in the price or decrease in the price?
Increase in the price, sir.
No. When is that you will make a loss? Yes. Yeah, somebody said decrease. You are taking short position on a put option, right? So you are entered a contract with whom? Who is the other party with whom you are entering into the contract here? With whom you are entered into the contract here? Put seller has entered into the contract with whom? Yes, quickly. Triveni, who is the other party with whom you are entered in the contract?
Call buyer, sir.
No, ma. How it is a call buyer? Put buyer. Okay.
Yes, sir.
Right? Because you're taking short position on a put. When you take short position on a put option, the other party is long position on a put, right? So when you say you are taking short position on a put and you are receiving the premium of 2.25, right? So you have an obligation to buy, whereas a put buyer, right, who pays a premium of 2.25 and he has a right to sell. And when is that he will be selling? When the price decreases in the market, he will be selling to a put seller, right? When the price decreases, put buyer will come and sell at that 30, right? Put buyer will buy at lesser price from the market and sell to at 30. You as a put seller, you have an obligation to buy at 30, even though you know that the market price is less in the market, but still you have to buy at 30. So when the price decreases, you will be making a loss. When the price rises, you will not be making any loss, but you will be enjoying the premium of 2.25. That is in the case of a short position, right? Short sale on equity. When is that you will be making a loss? What change in the price you will be making a loss? What changes in the price that you will be making a loss? Yes, quickly. What change in the price that you will be making a loss? Change when I say it is increase price or decrease the price?
Decrease the price.
Short sale on equity. Yes, any other answer? What change in the price that you will be making the loss?
Increase in price, sir.
Increase in the price, not decrease in the price. If the price decreases, you will make gain. Short sale on equity, what actually happens here? The buyer will sell the share at 31. Borrowing the share from a broker, he will sell the share at 31. The buyer is not possessing the share, right? So the investor will borrow the share from a broker and sell the share in the market for 31 and promise to pay back the share to a broker in the near future, right? If the price decreases, the investor can buy the share at lesser price and return back the share to a broker. If the price increases, right, the investor has to buy the share for higher price and return back the share to a broker, right? So when is that the investor will make a profit? If the price is less than what he has been entered into short sale on equity, right? If anything less than 31, investor will make the profit, right? If let's say the market price is 30, so investor will buy at 30 and return back the share to the broker. He will be making a gain of 1 rupees, right? That is where. So decrease in the price will make a profit. Increase in the price will make a loss, right? And the third position is you are supposed to take long on a call option at rupees 30 strike price. When you take long on a call, right, what happens? Whether you need to pay the premium or you are going to receive the premium. Whether you are going to make the payment of premium is 3 rupees. Whether you are going to make or you are going to receive.
Make, sir.
You are going to make the payment, right? So it's a cash outflow. Fine. So it's going to be a cash outflow of rupees 3. Now, what is your total cash inflow or outflow, right? So when you take short position on a put option, it is a cash inflow of 2.25. When you take short sale on equity, it is a cash inflow of rupees 31. When you take long on a call option, it is a cash outflow of rupees 3. So total cash inflow or outflow when you take it out, 31 plus 2.25, right? 33.25. 33.25 minus 3, it comes out to be 30.25, right? Clear? So you will receive 33.25 rupees by taking short on a put option and by taking short sale on equity. From this cash, you will make a payment of rupees 3, right? So what is the leftover cash with you would be the 30.25 rupees. Is it clear with everyone, or need some one more explanation? Is it clear?
Yes, sir.
Okay, so this is today. Now what is that you are having is you are having a surplus cash of rupees 30.25 with you. Okay, so this cash, what you will do, rather keeping ideally for the 3 months, you will be reinvesting this cash at the 10%. Okay, so we'll be reinvesting this cash at a 10% for 3 months. That is 30.25. That is, these are the 4 activities that to be carried out today. That is at the time T0. Fine. So now at the time T1, right? At the time T1, that is on the last day of the 3 months of the contract, which is going to get expired. We don't know what exactly the spot price would be on the date of expiry. Right. So here what we'll do is we will assume the strike price, what we have been entered into the contract, would be the spot price on the 90th day or the last day of the 3 months contract, right? So we'll assume the spot price to be 30. Here that is the reason I have written assume S not a spot price is equal to K. K is nothing but the strike price is equal to 30, right? Because we have not calculated the fair value here, so we are assuming the strike price would be, the other alternative way is only we can assume the strike price to be the same as the spot price on the 90th day. If the no price is available, if the price is given, we'll assume that price. If it is not available, so we can consider the strike price as a spot price there. Right, now let's evaluate and try to see what are our positions. The first decision, that is what we have been taken, is we have taken short position on a put option where you have an obligation to buy at rupees 30, right, for which you have received 2.25 rupees. Now you say me the market price is also 30, right? We are assuming on the 3 months expiry on the date the spot price is 30, right? The market price is also 30. You are entered short position on a put option where you have an obligation to buy for 30. Whether the put buyer who has a right to sell to you here, right, whether he will come and execute the contract or withdraw the contract. What would be the action of a put buyer here? What is the action of a put buyer? Whether he will execute or withdraw?
Withdraw, sir.
If he withdraw, right, what is that he will be losing?
Only the
How much
premium.
he will be? Yeah, he will be losing only the 2.25. Even he execute also, it will not be making any difference for a put buyer, nor even for a seller, right? Because the strike price and the spot price are the same. Hence, already the put seller has received 2.25, right? Even put buyer execute or withdraw doesn't make any difference there. So 2.25 is the same gain, right? So second position, what you have been taken is short sale on equity that you have been taken for 31. Now the market price is 30, right? So you are making a gain of 1 rupees because so you will buy the share in the market for 30, right? And give it back the share to a broker from where you have been borrowed. Okay. Then you already sold the share at rupees 31. So you are making a gain of rupees 1 there. Fine. Clear? Second position is also clear.
Yes, sir.
Okay, now go for the third position. The third position, you are taken long on a call where you have right to buy for rupees 30, for which you have paid a premium of rupees 3. Now even the current market price is also 30, right? Whether you execute or withdraw doesn't make any difference, because already the market price and the strike price is 30 and the 30 is same, right? So whether you execute or withdraw, you'll be having a loss of rupees 3 there, right? Because already you paid, right? Then apart from that, what is that you already done is you had a surplus of rupees 30.25 rupees, for which what you have done is you have invested at 10%, which was a prevailing rate of interest in the market, right? Just a minute. Okay, what is that? The same problem, right? Yeah, you are invested 30.25 rupees. You are invested for 10% for 3 months, right? So now what you will do is you have invested. What is the interest that you have been earned, right? When you want to calculate the interest, you need to apply the principal plus interest formula. That is P, open the bracket, 1 plus R into F. So P is 30.25, open the bracket, 1 plus. Why we use 1? Because you will get both principal plus interest amount, right? 1 plus risk-free rate is 0.10 multiplied by 3 divided by 12. That is 3 divided by 12 multiplied by 0.10 plus 1, right? Close the bracket, multiply with 30.25. So you will get principal plus interest. Take out the principal amount of 30.25. So what is interest is left over is only 0.756, right? It is the interest which you have been earned on the principal value of 30.25. Now, when you simplify all these things, what is the total cash flow is? 2.25 is a positive cash flow, 1 rupee is a positive cash flow, minus 3 is a negative cash flow, plus 0.756 is a positive cash flow. When you simplify all this, so you'll be getting as 1.006 rupees per unit or per stock, right? But you all know that derivatives are being traded in a contract which is having a lot size of 1,500. So that makes very attractive for an arbitrage. Now, if you look at this, a 1 rupee is a small value, but the contracts are being traded in a lot size, right? That increases the more price, right? With a zero investment, still you can make the profit as a arbitrage here. This is how the arbitrage opportunity that exists into the option pricing. Fine. You have any questions here?
No, sir.
Okay, no problem. Then second problem would be in a homework to you all, right? Second problem. Look at the second problem. Check out that. So that would be a homework to you all. You need to solve and come back to the class. Okay, any doubts in this? No issues?
No, sir.
Okay, solve it and let me know if you have any difficulty. Then if you are finding any difficulty, then I will chip in into it. Okay. Fine. So here we'll stop the discussion for today. So next class that I will be take up the third problem into the next class.